We start with a look at the recent performance of Wall Street, where the second quarter has proven to be a blockbuster for many major financial institutions. J.P. Morgan Chase, Citigroup, Morgan Stanley, and Bank of America have all reported significant increases in profits within their wealth management divisions. For instance, J.P. Morgan's Asset and Wealth Management Unit saw a 33% year-over-year surge in profit, reaching about $2 billion, with client assets up 19% to $7.7 trillion. Similarly, Citigroup's Wealth Division marked its ninth consecutive quarter of revenue growth, with profits leaping 51% year-over-year. This trend isn't limited to these few institutions. The entire wealth management landscape is experiencing a period of substantial growth. Morgan Stanley's wealth and investment management businesses have crossed a historic milestone, reaching $10 trillion in total client assets after pulling in a record $148 billion in net new assets this quarter. Meanwhile, asset managers like BlackRock are also seeing significant inflows, with total assets under management growing 22%, driven by a record first-half net inflow of $321 billion. However, amidst this optimism, there's a note of caution. J.P. Morgan's CFO Jeremy Barnum has pointed out that the market is extremely risk-on right now, and CEO Jamie Dimon has added that while things are going well, it's uncertain how long this trend will last. This balance between celebrating current successes and being mindful of potential future risks is crucial for investors and financial institutions alike. As we consider these developments, it's essential to maintain a balanced perspective, acknowledging both the strengths of the current market and the potential vulnerabilities that could impact its future trajectory. Whether you're an experienced investor or just starting to navigate the world of finance, understanding these dynamics is key to making informed decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show and we've got a fascinating story to dive into. For those who may not be familiar, stablecoins are a type of cryptocurrency designed to maintain a stable value relative to a fiat currency, such as the US dollar. They've become increasingly popular in recent years, with the market now valued at over $300 billion. However, as we've seen in the past, stablecoins can be vulnerable to runs and depegging events, which can have significant consequences for investors. Warsh's comments suggest that the Fed is taking a cautious approach to regulating stablecoins and is warning investors not to rely on the central bank to bail them out in case of a crisis. This has sparked debate among crypto enthusiasts, with some arguing that the Fed's stance could stifle innovation and limit the growth of the industry. On the other hand, others see Warsh's comments as a necessary reminder of the risks associated with investing in cryptocurrency. As we've seen time and time again, the crypto market can be highly volatile, and investors need to be aware of the potential downsides before putting their money in. It's also worth noting that the Fed's approach to regulating stablecoins is still evolving, and it's likely that we'll see further developments in the coming months. The Genius Act, which was signed into law last year, aims to provide greater oversight and regulation of the stablecoin market, but its implementation has been delayed. As we move forward, it will be interesting to see how the crypto industry responds to Warsh's comments and the evolving regulatory landscape. Will investors become more cautious, or will they continue to flock to stablecoins and other cryptocurrencies? Only time will tell. One thing is certain, however: the intersection of cryptocurrency and traditional finance is an area that requires careful consideration and nuanced understanding. As we navigate this complex landscape, it's essential to stay informed and up to date on the latest developments. Welcome back to the Riskwiser Zone. Today, we've been exploring the intricacies of the market and how they impact our investment decisions. As we wrap up this episode, let's dive into a fascinating story that highlights the shifting landscape of technology and its effects on various industries. Recently, IBM's CEO Arvind Krishna, made a striking comment about their clients' budget allocations. It appears that these large multinational corporations are temporarily freezing their planned budgets for traditional software and server solutions, instead redirecting those funds towards purchasing equipment for artificial intelligence. This move is largely driven by the need to secure supply-constrained infrastructure ahead of expected price increases. This development signals a significant shift in how companies are prioritizing their IT spending. The first wave of AI adoption, which occurred from 2024 to 2025, was primarily driven by tech giants like Microsoft, Alphabet, Meta Platforms, and Amazon. However, we're now witnessing the second wave, where numerous companies from the broader market are joining the process. This includes financial institutions, medical firms, and other sectors looking to implement AI technologies to optimize costs and increase efficiency. The implications of this shift are far-reaching. Companies like Dell and Hewlett-Packard Enterprise are experiencing pronounced growth in AAU server sales, as they serve as system integrators for businesses looking to adopt AAU solutions. This reallocation of capital has significant consequences for investors, as it suggests that demand for chips and infrastructure solutions will remain strong. On the other hand, the enterprise software sector may face a temporary slowdown as corporations focus on building out their AI infrastructure. Traditional software providers will need to adapt to these new conditions, potentially leading to stagnation in standard software sales. As we consider the broader implications of this shift, it's essential to remain fair and balanced in our analysis. While some sectors may experience growth, others may face challenges. It's crucial for investors to be aware of these dynamics and adjust their strategies accordingly. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.